The S&P 500 just keeps breaking records, now sitting at a total market cap of over $60 trillion for the first time ever, and year to date also many companies are up double digit. We even have today Bitcoin hitting a new all-time high, crossing over $125,000. And whilst all of this sounds very great, many investors are now starting to get very anxious. They're getting very nervous indeed, and this is ultimately because no matter what kind of news comes our way, inflation, geopolitical tension, weak earnings, the markets just continue to keep climbing higher. So the big question is, how long can this really last? On one side, we have retail investors who are still very heavy buyers. They've been net positive almost all of 2025, and in fact, this has started to really accelerate in the recent weeks. But on the other side, we have hedge funds and institutions who have been quietly offloading positions for months now, and this is where it gets very interesting. It's not just them, we're now seeing members of Congress themselves starting to sell, and not just random names. These are 8 specific stocks that lawmakers have in fact recently started to dump, and in today's video we've sifted through every one of these recent trades to show you exactly what they've sold, why it matters, and whether we think it's time to dump, hold, or even buy those stocks. And remember, tracking congressional trades isn't just for fun. Over the past 3 years, Congress have massively outperformed the S&P 500. We have some members, in fact, like popular Nancy Pelosi, who hasn't just outperformed, but when we take a look over the last 10 years, her portfolio is up more than 800% compared to the S&P that's up over 250 in the same period. So when they start selling, perhaps it is time to pay some serious attention. And remember, we do sometimes talk about potential insider information that makes these members of Congress have the edge over retail investors. And what makes it incredibly frustrating is that the consequences, if they are to have violated this act, are in fact minimal, as noted, inconsistent, and ultimately not recorded publicly. So let's dive into the 8 stocks Congress have dumped. As we said, we'll give you our own valuation perspective too. Starting off with Alphabet, what an incredible run, a company that seemed to be dead just months ago, up 48% in the last year. Year to date, up 30%, and in fact, in just the last 6 months, up 63%. Wasn't that long ago where it was trading around $140, where every investor was incredibly bearish on the company, and now it's sitting not far off all-time high, $256, where we get a buy rating from Seeking Alpha. Wall Street 4.47 out of 5, that is very near to a 4.5 to flip it into a strong buy rating, and we actually get to see the forward P at 24.7, well above historical 21.6. Again, we were covering this for many times where it was trading in a severely undervalued space. It now looks to be above the historical average, potentially overvalued, something that also is confirmed when we take a look at the blue tunnel. Now, new investors, blue tunnel within these parameters highlights the intrinsic or fair value. Quite a significant period it was trading below. We now see it for the first time in 2025 trading above, again, potential overvaluation. And what makes it fascinating, when we zoom out to the last 5 years to see this in another potentially undervalued space, you'd have to go all the way to around the beginning of 2021. So fascinating to see. Doesn't necessarily mean it is a sell. As we said, we'll give you our own valuation. And before we jump into that, worth considering, what are the institutions doing? We highlighted at the beginning they're selling a lot of companies. Are they doing the same with those members of Congress are selling? Well, 40% ownership, $57 billion worth of selling in just the last year. They've bought a lot more in the same time frame, more than double, and they've also bought near double in Q3. So definitely one they are very bullish on. They are net buyers. If you wanted to see the reverse of the trend by quite a significant distance, you'd have to go to Q2 2023. Now our intrinsic value comes to $229 derived from the discounted cash flow valuation, whereas you can see we have the free cash flow year on year. Average growth 20%. Last year though was sitting at 5%. We've gone for 12% moving forwards. As you can see, low, medium and high, 10, 12, 14. As always though, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, getting to your own numbers, whether it's for Google or any others. But before we dive in, worth flagging now, not long ago on a reverse DCF, it was around 10%. Today we now sit at 13% over the longer term. So straight away, if you believe this is too high for Google, then it could look to be overvalued. Too low, then undervaluation. Using the 12% growth rate though, with our discount rate, we get the present value of future free cash flow terminal price, add together with the cash, subtract total debt, gives us the equity value, divide by the shares outstanding, 229, indicating downside of 7%. Now you may believe we're being actually optimistic at 12%, so we will show you as well for transparency at 10, 199, downside of 19, or you may believe the opposite, we're being way too conservative, and at 14, 263, indicating 7% upside. As always, we do like to take through the middle rate where we're not done there because we want to see what is the margin of safety on offer, where we like to buy, execute at a 10% MOS if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. What this actually flags, if you believe the growth rate of 12% to be reasonable, then you're not getting any margin of safety. You're paying a premium of 7% given the intrinsic value does sit below the current price. If you wanted a 10% MOS, well, a buy at 206, at 20%, 183, and 25, 172. Wall Street themselves, even with their near strong buy rating, on average see this at $248 into 2026, indicating only 1% upside. Now give us your thoughts on company number 1, but we'll also flag for those that believe we're being too conservative. At 14%, intrinsically 263, that gives rise to a margin of safety, but still on the lower end at 7%. Nonetheless, if you believe this to be reasonable, well, at 20%, a buy at 210, and at 25, around 197. So let us know, first stock members of Congress are selling. That is in fact Google. Before we continue, we just want to let you know we have released our latest free weekly article. We drop one every single Sunday morning covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock they've been selling is Micron Tech, up 84% in the last year, up 123% year to date. One that we covered quite a lot when it was trading near 52-week lows, looked like an incredibly strong buy. Now members of Congress selling pretty much at all-time highs. We get a strong buy from Quant with a double buy from Seeking Alpha and Wall Street. Wall Street again, like Google, very near a strong buy too, and we actually see it pretty much trading at a forward P in line with its historical 5-year average, and we also note a reasonable signal when we look at the blue tunnel. In fact, many opportunities, as we highlighted, to buy this severely undervalued, so make sure you are subscribed, notification bell is on. As of today though, it is sitting right in the middle, so according to this, and the fact the forward P is pretty much in line with the 5-year average, it does look to be reasonably valued. Institutions with their 81% ownership were selling 11 billion in the last year, buying nearly double at 18 billion in the most recent quarter. Also, they have been strong net buyers. Reverse of the trend though, you would have to go not far away at Q3 2024. Now our intrinsic value, $176 derived from the DCF, really is subjective, comes down to whether you believe it is a low, medium or high. Baked in today is 16.1%. So if you believe 15% to be most appropriate, in terms of a margin of safety, well, it is in fact nil. You are talking about a 7% premium. If you believe actually the higher end isn't something we should incorporate and want to look at the medium, at 10%, $128, the premium sits at 47%. On both occasions, no margin of safety. Wall Street, very similar to Google, very minimal upside, even with the near strong buy rating, $198, 5% into next year. Now, if you did want to make a note of the higher end in terms of the margin of safety, if this is one that is on your radar, at 10%, a buy at 158, at 20, a buy at 141, and 25, $132. Stock number 2, Microntech, do let us know your views. The next one they're selling is Oracle, up 71% in the last year, 72% year to date, trading not far off their all-time highs with a single buy rating from Wall Street. Now this is what we would call a severely overvalued signal, forward P 41, well above the 5-year at 19. That's also reflected when we look at the blue tunnel, massive disparity between where the company sits today and even the upper end of the blue tunnel. If we zoom out to the last 5 years though, this one pretty much up until around the end of 2022 has been trading at a premium, and institutions with their 42% ownership selling 23 billion in the last year and buying more in the same time frame have actually sold more in Q3, so it looks to be like they could be in tune with members of Congress who have in fact been dumping. And our intrinsic price at $198 in fact highlights baked in on a reverse DCF 25.3. Whether you use the low, medium or high, on all accounts we are talking about downside, but maybe you look at this and believe we're being too conservative. So really, even looking at the upper end of 20% growth moving forwards, we're talking about Oracle having a 44% premium on the price today. Wall Street though, interestingly, see this at $341 into next year, 20% upside. Let us know your views on Oracle. Maybe you agree with members of Congress and institutions who have been selling, or maybe you do see this one as a strong buy today. Unlike the previous companies, we move on to Accenture, which is in fact trading at the other end of the spectrum around this 52-week low, down 32% in the last year, down 30% year to date. Over the last 10 years, it has though marginally underperformed the S&P with a double buy rating, although fairly weak from Seeking Alpha. Forward P, first time today where we see disparity going the other end, is trading at 17.8, well below the 5-year average of 27, as well as a yield of 2.7%, well above its 5-year of 1.5. And we also note an undervaluation signal, pretty much growing in disparity from around June this year, where the blue tunnel is marginally increasing over time. That isn't a bad thing to note at all. Over the last 5 years, what we're seeing from this company is intrinsically it is growing very steadily, but the stock price has been trading at a premium from 2020 to 2022, then a reasonable signal, and for the first time in quite some time, we're seeing quite a large discount. Institutions, 75% ownership, selling 13 billion in the last year, buying more than twice as much, buying a lot more in Q3, so they are definitely taking advantage of the drop we are seeing around this 52-week low. Reverse of the trend, well in fact you would have to go outside of the parameters that we are using today. And for Accenture, $335 on a reverse DCF, only 1.6% growth moving forward. No matter which one used today, 6%, 8% or 10%, each one is showing upside. Using the most conservative at 6%, that does give rise to a 27% margin of safety. Using a 30% MOS though, it would be a buy at $234. Wall Street themselves, 295 into next year, 20% upside. Let us know, maybe Accenture is one you disagree with members of Congress and do believe at a bare minimum it should be on the watch list. The next one they're selling is FedEx, down 7% in the last year, down double digit year to date. Over the last 10 years, massive underperformance of the S&P, trading around the mid to low end of the 52-week range, with another double buy from Seeking Alpha and Wall Street, although again Seeking Alpha a very weak one at that, and it's trading not too dissimilar from its 5-year average at 12.8. Yield though is a bit higher, 2.4 versus 2, and we also get a reasonable signal. In fact, it is sitting right there in the midpoint of the blue tunnel, although unlike Accenture, which was steadily increasing, with FedEx we get the opposite, where intrinsically the fair price is on a downward trend, something that when we zoom out to the last 5 years doesn't really give you faith in terms of a company that is very consistent. In fact, it did peak around mid-2022 before a very large drop, and even with the increase we're now seeing at the beginning of 2025, the intrinsic value of the company is on a downward spiral. 85% ownership though from institutions, with 6 billion selling, 9 billion buying, so about 50% more. Little bit of buys, a little bit of selling in Q3, nothing too major when we do compare it to other quarters. And if you want to see the reverse of the trend, well, not by a massive margin, but Q3 2024. In our intrinsic value, which is the average of the 4 models today, and as always, you can grab a copy of this model by clicking on the pinned comment below, comes to 267. We'll just flag solely on a DCF, it is lower at 230, where baked in today is 8.5% moving forwards. Margin of safety, we do get one at 9%, probably not a lot for many investors. So at 20%, a buy at 214, at 25, bang on the $200 mark. Wall Street do see upside of 11% into next year, $272. Is this one that gets you excited? Maybe you prefer UPS, or this industry as a whole is not one that you're considering. We then move on to Starbucks, down 10% over the last year, year to date down 5%. And when we typically talk about companies that are overvalued, this name continues to crop up. Over the last 10 years, massive underperformance of the S&P, up 44%. All-time highs, we're talking around 4 years ago today, in July, where it was trading at $126, now trading towards the lower end of the 52-week range. We get a traffic light system, sell from Seeking Alpha, very weak buy rating from Wall Street, with a hold from Quant, trading at a forward P of 35, not only very high in isolation, but well above the 5-year average of 28.8, yield 2.9%. It is above the 5-year at 2.3, but bear in mind the dividend safety score 60 does hit borderline safe, so a little bit questionable, something we can take a closer look if this company does interest you, and probably no surprise then to see this overvaluation signal. In fact, it is sitting above the upper end, something we've noted for quite a period over the last 12 months. Zooming out to the last 5 years, again, very similar to the previous company, the intrinsic value hasn't consistently been in that upwards trajectory, and institutions with 72% ownership selling 10 billion, buying 17 billion in fact in the same time frame, pretty much bought and sold the same amount in Q3. If you really want to see the reverse of the trend, well, we notice a small one in Q2 and that of Q3 2023. Now, our intrinsic value comes to $75 on a DCF, only marginally higher, where baked in is 8.2% to the future free cash flows. Overall, this company, in our view, one we really disagree with Wall Street. We see this trading at a 15% premium. Wall Street, with an incredibly weak buy rating, as highlighted, see this at $102 into next year, 19% upside. Now, if you just wanted to make note, at a 10% margin of safety, this would look to be a buy at $67, at 20, 60 on the dot, and 25, 56. Let us know whether you agree with what we believe as well as members of Congress, or you see this one as undervalued and a very strong buy. We then move on to BlackRock, up 22% in the last year, up 13% year to date. Over the last 10 years, has marginally outperformed the S&P, trading very near to its all-time highs, as well as a double buy, in fact near strong buy from Wall Street at 4.41. We do notice though, forward P 24 above the 5-year at 20, yield 1.8 below historical 2.4, as well as an overvaluation signal, although you could argue it is just slightly above. This one over the last 12 months hasn't really entered the undervaluation signal, and that's something also confirmed when we look at the last 5 years. Very rare to see this severely undervalued. We do get a little spot in mid-2022. And institutions, even with 81% ownership and selling 15 billion, buying pretty much twice as much, they've sold twice as much in Q3, so maybe for BlackRock, they also have started to turn bearish. And our intrinsic value, $867, DCF quite a bit higher at $962, where baked in is 12.6% moving forwards, gives rise to not a margin of safety like we're seeing on many companies today, in fact a 34% premium. If you wanted this at a 10% MOS, a buy at $780, at 20, $693, and 25, $650. Wall Street themselves, $1,226, only 6% upside into next year. Let us know your own views on BlackRock today. We then move on to ASML, and this is one we'd covered for many periods of time, constantly saying this was severely undervalued, and even with mentions of talking about this company on a very consistent basis, there was one reason why it was severely undervalued. Now it is over the last year up 24%, year to date up 49%. Over the last 10, massive outperformance of the S&P, up more than 1,000%, trading pretty much around its 52-week high. There was a time not that long ago where it was at the 52-week low of $578. We also get another double buy from Seeking Alpha and Wall Street. We see the opposite of what we saw for quite some time, now looking potentially overvalued, forward P 38 versus historical 33, as well as a potential overvaluation signal. In fact, most of the last 12 months, this one was trading undervalued. Now we see it completely on the opposite end. It's barely spent any time in its intrinsic price. That is absolutely incredible to see. And actually, when we zoom out to the last 5 years, this one more often than not does trade at a very large premium. Maybe this is something we will now start to see for quite some time, or we will get a little bit of a pullback. Institutions with their 26% ownership sold 12 billion, actually more in the last 12 months than they bought, around 10 billion. Not much movement in Q3. In fact, in Q2, a little bit more selling than buying. You want to see the largest reversal of the trend, well, you'd only have to go to Q4 2024. Now, our intrinsic value at $909 derived from the DCF firstly highlights 13.8% baked into the numbers. Again, not that long ago, it was around the 9 to 10% mark. And even if you wanted to put this at the higher end today of 14%, we're only talking around 2% upside. So using the middle rate at 12%, we are talking about a company now trading at a 13% premium. Even Wall Street see this lower over the next year at negative 10%. That is downside. Their price target, $925. Now, if you wanted to make note, at 10%, a buy at 818, at 20%, a buy at 727, and 25, a buy at $681. Let us know on these 8 stocks today, as well as ASML. Do you see them as a buy, maybe a hold, or a complete avoid? Don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us at the Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.